Donald Trump delays his new 50% tariff on Europe until July the 8th, which boosts European stocks overnight. But gold remains near record highs on all the uncertainty. Singapore's factory output rebounds, reducing the chances of a technical recession, and the Reserve Bank of New Zealand is expected to cut its official cash rate again tomorrow. That's coming up in our 5 Things in 5 Minutes on Tuesday, May the 27th. And then, in our deep dive interview, ANZ Senior Commodities Strategist Daniel Hynes has taken a closer look at the aluminium market and finds supply issues are adding to the tensions, also building over more trade barriers.
We're starting to see that growth in new supply coming onto the market fall quite sharply. And that could have quite a big impact, bigger than potentially what the demand side could suffer from if we do see an economic slowdown.
But first, in 5 and 5 with ANZ, gold prices rose 2% over the last 3 days to $3,371 an ounce as of 4 a.m. Sydney-Melbourne time this morning, after Donald Trump's latest trade escalation to impose a 50% tariff on imports from Europe. His decision yesterday to delay the tariff saw gold give up about 0.5% of those gains overnight. ANZ Commodities strategist Sunny Kamari explains why the latest trade drama is helping gold.
This marks a clear re-escalation of the trade war following a brief pause in tension with China, and the renewed uncertainty is expected to revive having demand for gold, which has started retreating after the US and China agreed to a 90-day pause with significantly lower tariffs. And it is just a week left to negotiate a trade deal before the proposed tariffs take effect. So markets will be increasingly worried about renewed macroeconomic uncertainty, and which can potentially bring bouts of volatility across financial markets, and this will likely benefit investment flows into gold.
As of 4 a.m. Sydney-Melbourne time, the US dollar index is down 0.1% at 98.90 on the index. The Aussie dollar is down 0.1% at 64.88 US cents, and the New Zealand dollar is up 0.2% at 60.02 US cents. US stock markets are closed for a holiday. Number 2. Sunny says there's more than just Trump's trade uncertainty underneath demand for gold.
Even if the situation de-escalates, as it happened last month with China, underlying factors such as waning trust in US assets due to its structural debt problems, geopolitical uncertainty, concerns over US economic growth, higher inflation, and equity market volatility continue to provide a supportive backdrop for gold.
Number 3. The Reserve Bank of New Zealand is expected to cut its official cash rate again tomorrow by 25 basis points to 3.25%. It's down 225 basis points from its peak last year. ANZ New Zealand Chief Economist Sharon Zollner says the chances are slim for a bigger rate cut or no rate cut at all.
So that doesn't mean that there can't be a surprise on the day, because of course the Reserve Bank publishes a forecast for the OCR, and they're at great pains to say it's always conditional, don't take it as a promise. Data surprises us all the time. But in terms of the data that's come out since the last set of projections in February, and focusing particularly on the data since April, their last OCR decision, it's been a bit of a mixed bag, but overall we think it probably justifies maybe an OCR track that's a little bit lower, 5 or 10 basis points lower, not least because actually the exchange rate is quite a lot higher than they thought it would be, and that's worth quite a bit, as well as the actual economic data that we've seen. But where it gets very murky is how much they might build in for the global stuff.
Number 4. Sharon says there has been a deterioration in confidence since the early April Liberation Day tariff announcements, which the Reserve Bank may try to take account of.
In this kind of environment, they may well publish a scenario saying, look, here's a plausible bad scenario and here's how we would respond. So just park that in case we need it, and for now we just won't build anything in. That would be one extreme. Or they could build a lot in, or they could go in a halfway sort of house. So the upshot is that there is still scope for the OCR to surprise on the day, but our best guess for what it's worth is that they'll lower the track to a bit under 3%, suggesting that yes, they do expect to cut again after this one, and then a decent chance that they will cut again further. So our own forecast is for the OCR to get down to 2.5%, but we certainly would not expect the RBNZ to show anything that gung-ho yet.
Number 5. There's good news from Singapore's industrial producers, who yesterday reported a rebound in April, with headline output up 5.3% from March and up 5.9% from a month ago. The detail was even stronger, says ANZ's Head of Asia Research, Kun Go.
Excluding biomedical manufacturing, the year-on-year rebound in industrial production was much stronger at 8.1%. This will help allay concerns about a technical recession following the Q1 GDP contraction, which was led by the manufacturing sector. Given the strong rebound in exports on the back of front-loading activity, this should provide further near-term support for Singapore's industrial production numbers heading into May and June, leading to a quarterly rebound in manufacturing GDP, which should help the city-state avert technical recession in Q2.
Couldn't go there. Now, in today's deep dive interview, ANZ senior commodities strategist Daniel Hynes has taken a closer look at the aluminium market and finds that supply issues are adding to the tensions around rising trade barriers.
What we're seeing at the moment is obviously spillover from sort of years of underinvestment, particularly through the sort of the COVID period, but also now with so much uncertainty around the economic backdrop, companies are, I suppose, just reevaluating their investment plans, their expansion plans, and as a result, we're starting to see that growth in new supply coming onto the market fall quite sharply, and that could have quite a big impact, bigger than potentially what the demand side could suffer from if we do see an economic slowdown. So it's always smart to obviously consider both sides of the market, and I think the supply side issues have gone a little bit unnoticed in recent times.
Yeah, could you talk about where in particular in the world you're watching output numbers to see where we're tracking?
Well, I mean, when you talk aluminium, you always have to consider China being the largest single producer. At the moment, they're operating just under their nameplate capacity, but officials there have indicated that they will not approve any additional increases in operating capacity going forward, in part due to sort of environmental issues, but also the broader sort of overcapacity phenomena that a lot of other countries have been arguing with China about. So that essentially stops any potential growth in output in China and leaves it to the rest of the world. And on that side of things, it doesn't look like too many projects coming through at the moment. Some through sort of Southeast Asia, such as Indonesia and the like, but really outside of that, there's very little scope. Certainly in the US, even though Trump has placed a 25% tariff on aluminium imports there, it's unlikely we're going to see any new investment in aluminium smelters in that country, at least over the next few years, considering the costs and planning required to get those into operation.
And the factor between demand and supply is inventories. You've got some interesting charts in your note about what's happening with inventories. How is that playing into the balance between supply and demand?
Yeah, well, I mean, the clearest indication of a tight market is the moves that we see in invisible inventories. And certainly in the case of aluminium, on the three sort of major exchanges in the US and Shanghai and London exchanges, we're seeing quite a sharp fall. In fact, it's fallen more than sort of 50% over the past 12 months. So there's clearly a tightening in the market. Other things can obviously have an impact. The sanctions on Russian metal have probably played a little bit of a part there. The LME last year banned the trading and holding of Russian aluminium on its exchange as a result of new laws in the UK. So there can be a little bit of off-exchange building as a consequence of that. But to me, it's clearly an indication of the tightening across the broader sort of aluminium market. And, the pace it's going certainly suggests that the market is pretty tight at the moment.
Given all that, what's your view on where aluminium prices head in 2025?
Look, I think for the moment, sentiment is going to be the key driver. On that front, it's going to be difficult for aluminium prices to really rise unless there's a clear sort of path out of this tariff war that we're currently in. But in saying that, I think with these tighter sort of fundamentals, there's really limited sort of downside to prices at the moment. So, look, we could see things push a little bit higher. It may be that 2 steps forward, 1 step back sort of trend. But certainly for us, I think we've seen the downside in prices, and the upside will really be determined by how that economic backdrop pans out over the next 6 months or so.
Daniel Hynes there. I'm Bernard Hickey. That was 5 and 5 with ANZ for Tuesday, May the 27th. Catch you tomorrow with a preview of Australian CPI inflation data for April, due later in the day. This podcast contains general information only, not investment advice. You should obtain advice for your personal circumstances before making any investment decisions. Please view the podcast disclaimer available via your media player or email.